your guides to a really great financial future. Tom and Don are talking real money.
Wow, it's another Talking Real Money video and audio? I thought we just did one yesterday. We'll do another one today. Hi, I'm Don McDonald. Tom Cock is hanging out over there. He's in the Bellevue, Washington office. I'm in the Virginia curtain room, white void room. I don't know where I'm going to be next time. I have no idea.
Out of the shower.
I have no idea where I'm going to be.
Maybe we should be glad you're in the shower. I don't know. So.
We're here to talk about money, how you spend it, save it, but particularly how you invest it. And a lot of the advice that is provided by folks in this industry really stinks. Either it is way too complicated. It's like, wow, you gotta have like a volume of books or volumes of books to learn their systems, or it's incredibly stupidly simple, like maybe too simple. We believe that the truth lies somewhere between the extremes. It's not that simple. It's not ridiculously complicated.
It sounds like our political system a little bit, somewhere in
it's a lot, but it's life, basically. Yeah. I mean, it's life.
Over there.
Life should be lived somewhere between the extremes. And those of you who are extremists in anything really should try to find your way to the middle.
Oh, this is a whole different program now.
Well, no, that was money. I'm talking about money. You
Okay.
don't want to be a trader.
Got it.
Over here. And you don't want to just be in, quote, this is what a lot of the advice is. You see that Buffett gives this advice, just be in an index fund. And when they say an index fund, they're always implying what?
The S&P 500.
Right.
Well, okay, and this comes from an article. The title was, "The advice, just invest in an index fund, is worthless."
So that's a little extreme.
I'm going to take umbrage with that.
With the title, yeah.
Yeah, the title, because what you're telling people is, in my mind, subtly, you need to go find something better.
Mm-hmm.
Now, here's what we do know about index funds. They're costs than actively managed funds. You're not going to pay commissions on them. The expected return of almost any index fund is going to be better than an actively managed fund due to the previously mentioned expenses, generally. And here's the other one. Generally, an index fund is going to be more diverse than an actively managed fund. Remember, an actively managed fund has somebody saying, well, I don't want to own Tesla anymore because it went from 17 to 695. It's going to go down, where an index fund is going to hold all those securities. So in a general sense, I think this poor advice. But let's dive into it a little bit because, yeah, if you just called us on Talking Real Money and asked what if you had to own one fund, what would it be? We'd tell you go own V as in Victor, T as in Tom, VT, right? Because it's one security that holds 8,800 stocks. It's pretty diversified. You get it at a very low cost. But if you said, well, I want to spend a little more time, a little more sophistication, okay, then you could own our 3 fund portfolio that's available at Talking Real Money. A little more time. You got to buy that one. You got to buy that one. You got to buy that one. You got to figure out the percentages. If you want to get into it more, if you really want to dive into this, and we have, thank you for those who follow our work, who tell us, I love spending time on this. I find it interesting. Then you could go own Paul Merriman's 10 fund. I think he has 10 funds at Vanguard, Fidelity, and Schwab. And by the way, we have 3 funds at the same 3 families.
Right.
So that's more time. I would expect the return probably be a little bit better because you own a little more small, you got a little more value, et cetera. But one more step. The way we manage money for our clients, we actually use 15 exchange traded funds, right? So
and
now
we have only recently changed everything over from actual
we haven't changed everything
fund.
over, but
we're in the process. Our new portfolios for new clients.
New portfolios,
we're going with ETFs because the costs are lower and there's some tax advantages.
There's a tax advantage, and here's the thing. It's going to be it's just more work. It's a trade-off, right, between how much time and energy and frankly discipline. Because when you hold 15 funds, there's a little bit of selling here, a little bit of buying. It just takes more time and work.
Well, and the other thing, because you mentioned discipline, Tom, the other thing that's is when you have those 15 funds, our tendency is to start looking at our statements and looking at which one is doing, and that we say to ourselves, like I've said, which one is doing better. And I don't want to sell the one that is doing better.
Yeah, exactly.
And that if you don't have that discipline, you're not gonna succeed to the extent you will if you stick with the plan.
And by the way, when people ask me, what's the one index you should own today? Guess which one I think it is. I'd send them to AVUV because it's U.S. small cap value, which is made for the last 10 months.
Dangerous.
I know, I agree, but my mind just says this is part of the
human psychology.
Rush.
Yeah.
Right. Go buy that because I don't own it, and it's had a great run.
If I paid any attention to you, I'd probably have all my money in that, which I don't, and I wish I did because I would be looking brilliant today. But the problem is, when do I get it out?
Right, exactly. So again, to me, first of all, telling people that just owning an index fund is worthless it's not worthless. To say otherwise is frankly ignorant. Number two, to me, the trade-off is how much time and energy you want to put into all this. If you just want to make it simple, which, by the way, no offense, most of you should do because it eliminates that thing Don just mentioned around discipline, which is very, very hard. When one is doing this and the other is doing this, it's really hard to say, I got to sell this one and buy this one, right? The higher and the lower. I'm showing you on the screen.
It's so emotionally difficult.
It is.
And anyone who's been investing for any period of time knows that to be the case. And I want to take it one step farther because, that S&P 500 advice, I think, is just too simple. I think I don't think it's all that good because it's a very focused portfolio, and I don't think that's right. I think you're going to get closer to having a portfolio that's right for you, not perfect, but closer, if you go with an age-based portfolio, if you don't want to do anything. I don't want to do anything. I don't want to hire an advisor. I don't want to do anything. I just want a portfolio that is probably right or close to right for my age.
And that's a good point, by the way, because then you have some bonds, right? If you just own VT, it's all stocks, which is hard for most people to take. I think that's fair. And again, remember, when you own an age-based target date, whatever name you want to put on it, you primarily own large U.S. firms. Primarily. You have a little tiny bit of other stuff in there, but not very much. And if that's okay, it's okay. It's not worthless.
Well, but Vanguard, okay. I know Vanguard uses international in their, but it's about 30% of the equities. Yeah,
correct. It's still a smaller
number.
But
still, there's a spectrum. The spectrum is everything from a target date fund for sheer simplicity, not perfect, but sheer simplicity, all the way out to hiring a 100% fee-only fiduciary who will build the right portfolio based on evidence and academic research. That is critical, not hunches, and who will keep you from doing dumb things.
We know that that's a bigger part of all this than most of you are willing to admit. Put it that way.
You may think you have control over your emotions, but you don't.
And by the way, I have an advisor here. So when I get crazy ideas, I go to and he says, no, that's a bad idea.
You're crazy, man. Stop it. Go back to your room, Mr. Adrenaline boy. 5-hour energy. No more 5-hour energy for you.
Not before my trading day starts. No, got it.
Oh, God. Give me some more Tesla.
Exactly.
You want a question? Quick.
Yeah.
Quick. We've got time.
Sure.
Jeez. He's got some sort of a meeting or something.
Isn't there always one?
Anymore? Yeah. I got meetings today, another one. I got a meeting tomorrow. I got meetings today, meetings tomorrow. Why do I have so many meetings? I just want to make stuff. Quit having meetings, corporations. All right. Here you go. The message. Don, I know you prefer voice messages, but if you're anything like my wife, you do not want to hear my voice.
No.
Oh, our audience is getting funny.
I'm kind of feeling bad on that one.
Excuse me, man. I didn't know you could get smoke here from Washington. All right, back to the question.
Yes.
I am 60 years old, have a terrible voice. No, I added that in. Hoping to retire in 5 years and have about $45,000 in a 457 account from a previous job. After 23 years, I'm finally looking at rolling it into my current 401k, which has better investment options with lower expense ratios. Is there any reason that I'm not aware of that it would make sense for me to leave the money in the 457 account? I appreciate your down-to-earth and common sense approach to investing. I'm doing my part to spread your gospel to the younger generation.
No, come on, say gospel with a little more feeling.
All right. I am doing my part to spread the gospel of Don and Tom to the younger generation. Keep up the good work.
Oh, now that was much better. Thank you. Okay, two parts. Number one, if you want to send us the portfolio, I'll be glad to look at it. I think you still go to 401411.com.
Yes, you can.
Send me the portfolio. We'll look at it.
401411.com.
Yeah.
Yes.
Number two, no, there's no reason not to move it in. Move it in there. Get it done. There's no, move it. Have one, by the way, this is something that comes up. We see it all the time. People have all these various accounts, and I used to work for that guy. I got this SEP IRA, I got this little 401k. Have one pre-tax account, one Roth account, and one post-tax account. That's it. Anything more, who knows what you own? How can you pay attention to all that? No. Clean it up.
Okay. Do you want another
That's an
one?
easy one. Don't you want to give me like the 4-paragraph run
Yeah,
on?
well, how about a 2-paragraph?
Okay. Yeah, go ahead.
I'm in my mid-30s. Ooh, one of those young people with a high income and a high savings rate, about 35%. Ho-ho!
Wow. That's
My risk
great.
quiz score is 88. Ooh. And my desired allocation is 70%.
Why?
70% U.S. total stock market, 30% international. So American of you. Well, less American than some Americans.
Yeah.
My backdoor Roth IRA, HSA, and taxable accounts are in Vanguard funds, although my employer 403B and 457 use TIAA, TIAA. My work-sponsored plans have the CREF Equity Fund with an expense ratio of 0.22 that tracks the Russell 3000 and a TIA CREF International Equity Index with an expense ratio of 0.05? Wow, that's pretty cheap.
That doesn't sound right.
That doesn't sound. I'm going to
Why
look it
would
up.
that be cheaper than the U.S. equity fund?
That's why I'm going to look them up. I asked my alternative reality department, or augmented reality department, HR, if they would consider adding VT or VTI. They haven't been willing to add this, but say I can do it through a self-directed option. I've never done the self-directed option, and I'm a little afraid I could make a mistake. What do you think about the above funds, and are they close enough? Thanks. Love the show. Keep up the good work. Let me look up that.
I think they're close enough, but I'd have to really see the expense ratio on the international. I bet that's 50 basis points instead of 20, instead of 7 or whatever.
Instead of 5 basis points. He had it down as 5.
My guess is that's 50 instead of 5.
But
That'd be
hold
a
on.
very inexpensive international equity fund. No, if you use brokerage link and you can access those other funds, that's fine. I don't think
he's
it's gonna
right.
be Wow, I don't think it's going to be a major difference, especially if you're getting international equities for only 5 basis points. You're not going to find that a whole lot cheaper anywhere else. So I'd stick with TIA there. By the way, a little warning about TIA, because this just came up in the financial media, that when you get close to retirement, and I hope they're doing this less, but they have put people in place to move you from your retirement plan to one of their portfolios, which are generally more expensive than the portfolio you're in your 401k. And huge fine because they incentivize their advisors, I'm using air quotes here, to move people to the more expensive product, even though they knew they had one that was less expensive. So be warned.
Yeah, the CREF Equity Index he's talking about is an institutional share. You can't get it.
Oh, okay.
And it looks to me though like he's saying 0.22, and CREF is showing a 9 basis point 12B1 fee and a 3 basis point management fee.
So that's 12 basis points?
Yeah, 12 basis points.
Wow.
So these are both cheap. I wouldn't mess around. I just leave them. They're
You
indexes.
could do fine. Okay, but then let's finish with the discussion around your U.S.-centric portfolio.
Yeah,
I get
good.
it. You live in the United States, probably have a bias, think we're a better country than the other 180 or whatever number.
Wait a minute, aren't we?
We'd like to think so.
They'd
I'd
like
like
to
to
think
think
they are.
so. Yeah, I mean, so, but here's the thing. Number one, when you look at the world, about half of the market capitalization, the value of companies is here, about half is outside. That's one. Number two, over the long haul, global diversification has meant a little more return, but less volatility. Number three, there are periods of time, and Don, you've done a nice job documenting these, where the U.S. market stinks. And I know that hasn't been the case really since the Great Recession. U.S. market's been better. But the period of time before that, being internationally invested, way better.
We have such short memories. It was
I know.
only 11 years ago
I,
that we ended a period in which the U.S. equity market lost money for 10 solid years. We forgot.
yeah. So I wouldn't do that. I would balance between the two. I just think it makes more sense. By the way, the other thing you get is currency diversification. As you know, there's sometimes U.S. dollar doing well, blah, blah, blah. All those reasons I think make sense to balance it, but it's your money. Congratulations on saving a third of your income, too. That is
Yeah, he
truly
is a
remarkable.
good saver. He is
That's
a very
awesome.
good saver.
So you're probably going to be good shape no matter what. But
Right, right. But the argument, I think, is sound. You know, keep it closer to 50-50 because it's too hard to get it exactly right. I mean, there are
yeah.
periods when the international market has been 51%, we've been 49, or we've been 50. I think currently we're like 57.
Last I saw was
40,
55, but I'll take it.
55 to 45.
Yeah.
So when you go 50-50, the other thing about going 50-50 is that the U.S. market has been hot, has been.
Yeah. So you're
If you
buying
go 50-50,
after it's gone up.
If you go 50-50, you're actually being a bit of a contrarian investor and saying, you know, since they've been 50-50 for so long, maybe they're going to get a little closer to that 50-50 and you get a bigger bang down the road, maybe, from the internationals. Maybe.
I think you're buying high, and you're chasing what's been the better return
Yeah.
for the
So
last 10 years or so. So
good
it
advice,
wouldn't be what I would
Thomas.
do. No, I think congratulations on being a great saver and being thoughtful about your retirement. That's terrific.
And of course, goes without saying, but we're going to say it anyway, for listening to our program.
Oh,
That makes
there's
you that puts you in the top 5% of intelligence in America.
Wait, top one. Come on.
Top
one
top
percenters.
Yeah,
All right.
well, maybe it's the top 0.1% when you look at
0.1?
our numbers, because what do we get, like 3,000 to 4,000 downloads a day?
Yeah.
So, wow, you may be in the top. I don't even know what the number is. It's too big for me to calculate. All right, thank you. Thanks for being there. Remember, you can call us anytime at 855-935-TALK and leave your questions, or you can send them in at talkingrealmoney.com on the contact form. If, by the way, you need bigger help, like we've talked about how you get little of that, little of this, and eventually, if you keep getting a little of this and a little of that, you're going to end up with a hodgepodge. Hodgepodgery is not a portfolio. It is the antithesis of a portfolio. You have hodgepodgery, get a portfolio. Let us help you. Even if you want to do it on your own, we're not going to charge anything. We're not going to press you with a sales pitch. Just go to vestory.com. That's our firm. And I promise, you'll get some help, and it won't cost anything, and you won't get pitched. And you might be a lot better off. And I'm pretty sure you'll enjoy the experience. It's painless. Just go to vestory.com, set up an appointment using the appointment form on the website, and tell a friend or 1,000 about Talking Real Money. Keep listening. Take care. I'm Don. That's Tom. We just hang out all the time. All we do is sit around talking real money.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information. information and disclosures. That's a wrap.